All right, Shubha, we're here live. Actually, not live, but we're here, and we're about to start our interview about the news that hit the market this week with OSFI changing the rules of mortgage financing. Shubha is with Capital Lend, and he's going to share with us uh, exactly how it's going to affect first-time home buyers, move-up buyers, and the real estate market overall. So, Shubha, tell us a little bit more about. Explain to us what exactly has happened with this announcement.
Yeah, for sure, Sharif, and thanks for having me out. I know it's a beautiful Saturday afternoon, and as you can see, I'm outside, so I apologize for the sunny background, and if I hope you guys can hear me okay. But essentially, what's happened right now this week is that the federal government has finalized some of the underwriting guidelines that they've been working on, working with federally regulated lenders for the past couple of years. They refer to it as the B-20 guideline and the B-21 guideline. So we are now just finalizing that, and essentially it's a year to the day since last year, and we announced the first stress test. So a couple more changes are going to be coming into play for 2018.
Okay, okay. So what exactly does this mean, Shubha? Like, they're saying they've reduced 20% buying power from the buyers. Prices are going to drop as a result of, like, is this actually going to happen? Like, what does this mean?
So I mean, yeah, what's essentially happening, and I'll give you the basis of what's going to impact consumers the most. So today, when a consumer buys a home, if they're putting less than 20% down, so if they're a high ratio mortgage borrower, they'll be qualifying at what the stress test is, which is the Bank of Canada benchmark rate, and that was introduced last year. So instead of qualifying at rates today are ranging between 2.99 to the low threes, they would be qualifying at 4.89%, which as we know over the past year impacted majority first-time home buyers and those just entering the market. Now the rule change has just been announced, which is going to take effect January 1st, 2018, applies to all mortgages across the board, regardless of what you're putting as a down payment. And what it is that mortgage borrowers will have to qualify at the greater of either the Bank of Canada benchmark rate, which is 4.89, or the contract rate plus 2%. So I'll give you an example and we'll use a 5-year fixed rate today at 3.29%. So right now, if you were putting less than 20% down, you would have to qualify at 4.89. If you're putting more than 20% down, you would be qualifying at 3.29. What's going to happen starting January 1st is that across the board, everybody is going to qualify at 5.29 for that same mortgage. And that's where the buying power and the purchasing power is going to be decreased, quite substantially. It's going to have about a 20% impact on that.
So that sounds quite drastic. That sounds like home prices will be forced down so that purchasers can get into the market, or it's gonna really rule out anybody in the with the budget of $600,000 out of the market or move them out of the city. And people who live within the city are gonna just have access to smaller homes. So if you were looking for a detached up to 1.5, now you're gonna go for a semi-detached in the 1 million, for example, right?
Yeah,
If
sure,
we're
for
talking
sure.
about Toronto specifically.
So, I mean, a couple positives, we like to focus on, we're solution oriented, Sharif, you and I both, and we like to focus on how we can help our clients and make sure that they're getting, the best results and the best advice. So if we focus on that, and we look at what's happened over the past 8 years, we've seen 6 massive rule changes and government intervention take place. And at each interval along the way, purchasing power has been decreased. Starting with the change in amortization by decreasing it, starting from 40 down to 35 down to 25. There was change to servicing ratios, which impacted purchasing power. So every step of the way, purchasing power has been impacted. And when we look at this scenario, no different than any of those, it still holds true. But the one thing we have to keep in mind is that this is a federal law. So this isn't necessarily that, it's impacting specific micro geographic areas such as Toronto that we're talking about right now, or the GTA and surrounding. But when we look at, other areas, we have to consider, do they have the same concerns with purchasing power? Are their buyers not approving and qualifying for what their price points are? So definitely in certain areas, it could impact pricing and it could bring down, borrower eligibility, which may affect what clients can afford to pay, in turn of impact what the market's going to dictate as pricing. But overall, within the Canadian market, it remains to be seen whether it's going to bring down pricing across the board.
Yeah, yeah. So I've had a chance to talk to a few of our clients who are currently buying or looking to sell, and a lot of them are not concerned. And I'm just wondering if that's because we're here in the GTA, we're in Toronto, and people have more opportunity to purchase properties. And I'm just wondering if our market is different, obviously, from Quebec and from other parts, Alberta. It seems like a lot of people are not going to be affected by the price change, and they're not worried as much, right? So the common objection is, okay, we'll put more down payment. We have enough down payment, but it still affects the first-time home buyers, right?
So I mean, it affects a certain segment of the market, and
Yeah.
it really, not, and I won't specifically say first-time home buyers. I would actually rather say that first-time home buyers are now at an advantage. And why I would say that is because last year, when the rules were implemented and the stress test was designed solely around those putting less than 20% down, what happened is that many first-time home buyers got priced out of still growing market space. They weren't able to qualify at what the price points were, and the market was continuously appreciating because those move-up buyers and those that had already entered the market and established equity and had more money to put down were able to qualify at the lower rates. So the one advantage from all of this is that it does create an even playing field across the board. So regardless of whether you're a first-time home buyer or you're, putting 50% down, you're qualifying at the same rate. So now we're talking about even playing field, qualifying based on income. Now, when we talk about it in terms of, what market is going to be impacted by this, there are a lot of home buyers right now that are stretched, and there are a lot of purchasers that are buying near their maximum or near their limits. But on the flip side of that coin, Sherif, and you and I work with many of them on a daily basis, many people are buying well within their limits and well within what they can afford to buy.
Yeah.
So, will those people be affected as drastically? Not so much. Many people are buying within that kind of 20% buffer that we're talking about here today, right?
So what about what does that mean for the brokerage, for the mortgage business? Does that mean you're gonna go to credit unions now? Can anybody go to a credit union to get financing? Is private financing going to get more popular? Where is that going?
So the credit unions, and this is obviously a brand new announcement, just happened this week. So we're still waiting on details as all of the institutions work on their individual policies. So why you mentioned that, I know, is that credit unions are exempt from the federal law. They're all provincially regulated. Yeah. So how they choose to react to this news remains to be seen. There has been some discussion from some of the credit unions that they'll follow suit. Yeah. Some said that they may not in Ontario specifically, but they may across Canada. So we'll definitely bring more news to that as we get updates and as we find out. The private lending market will definitely see an impact from this, a growth on their side of the business, because they're unregulated. One thing that will happen, though, due to that is that private lending will become more conservative as the lenders watch and see what's going to happen and how this is going to impact the markets. As they're equity-based lenders, they want to ensure that the equity is strong and that the market remains strong. Yeah. Another interesting thing that happened with this rule change, Sherif, that I will mention is that there's been an adjustment to loan to value as well. So I know we're talking about stress tests primarily. That's kind of the major impact to the consumer. But there are some lenders that were regulated by loan to value, meaning that they couldn't play in the insured space, most specifically the subprime lenders. So the subprime lenders were forced to kind of stay at this 80% max loan to value because they couldn't insure their mortgages, so they couldn't exceed that 80% threshold. How they used to bypass this, or how they used to provide solutions. I shouldn't say bypass. How they used to provide solutions to their clients for those that needed to go a little bit higher than 80% was they used to do what we call bundle mortgages in the industry. And bundle mortgages are where these institutions would basically partner with private lenders, and the private lenders will cover some of the additional loan to value to ensure that the clients had enough funds to close. So those actually are no longer allowed as well under these new rules. So
Wow.
now those institutions and those alternative lenders are going to be strictly held within their loan to value lending guidelines.
So does that mean that they'll have an opportunity now to stretch out the amortization, or is that federally controlled as well?
Nope, the amortization has to remain. So, maximum 30 years for, uninsured mortgages with more than 20% down, and 25 years for high ratio insured mortgages.
Any banks? Oh, so all high ratio mortgages have to be 25-year amortization.
Correct.
And everybody else can go to 30 and 35.
They can stretch to 30. Some lenders still do offer a 35.
To 35. Great. So, Shubha, two things. Tell us what two things are going to happen here. Like, give us two ideas of where we're going to go with this.
So, I'm always going to start with the one idea of saying that, now it's more important than ever to make sure you're speaking with a professional, making sure that you're receiving the right advice and the right consultation along the process. We want to make sure that we're providing our clients, assistance and making sure that they're making the right choices. We talk about often what's happening with prices, where prices are going, and many people who have heard me speak understand where my philosophy comes on that. And as home buyers entering the market, price impacts only affect 3 times in your lifespan: when you buy, when you sell, and when you refinance, if your intention is to buy a home to live in for the long term. Does this impact investors and people looking to stay in the market short term? Certainly. If purchasing power is impacted, then we're potentially losing a portion of the buying pool, not all of it. But if we had 10 buyers lined up that could afford a certain property today, we may be losing 30 or 40% of those buyers. So now that same property will only have 5 or 6 buyers that could purchase on it, right?
Yeah.
So that's to keep in mind. But I think it's still nothing different than what we talked about last year, with making sure that we're getting the right advice, we're providing clients the right answers to their questions. We've always worked on the methodology of making sure that we don't overextend our buyers and making sure that they're buying within their budget and understanding what their monthly payments are going to be. So if we continue to do those things and buyers are continuously buying within what they can afford, we all need a roof over our head at the end of the day, right?
That's right. Well, Shubha, thank you so much. Thank you for taking the time to do this with us today, and we'll keep asking you questions along the way.
My pleasure, Sherif. And if you have anything you need, you know where to reach me.
Awesome. Thanks, buddy.
Okay. Have a great weekend, everybody.